While mortgage rates are extremely low here in the United States at this time, new mortgages aren't the only way that you can use to sell your unwanted home here in Tucson. Let's discuss a lesser known yet commonly used method of selling and financing homes in Arizona, the wraparound mortgage, otherwise known as the wraparound mortgage or simply a wrap. You know, there are typically 4 questions when coming up using a wraparound mortgage here in Tucson. So let's discuss the 4 ways that we can use them to benefit you as a Tucson homeowner. Hi, my name's Carl Krenzel with Carl Buys Houses, the broker over here. And usually the question comes up first, what is a wraparound mortgage? You know, a wraparound mortgage is simply a situation where the home seller issues a loan to a home buyer. In a wraparound mortgage situation, the homeowner doesn't retire the original debt or home loan. Instead, they make an additional mortgage that wraps around the existing loan. This keeps the seller's loan in place while wrapping the new buyer's loan with the seller's loan around the existing loan. So how does this basically work, and how does a wraparound mortgage basically work? The seller and the buyer enter into an agreement for the overall sales price of the home. The buyer makes payments to a local title company to ensure that all the parties are protected. Depending on the terms of the agreement, the price, the interest rate, and the term are all determined in advance. This enables the parties to know how much is being paid to both the existing mortgage as well as the homeowner. So let's take the example of a $150,000 sales price on a $90,000 loan, right? So let's say that the home's original loan value is $90,000. Let's say the homeowner has a loan value of $90,000, okay? And the home's value is about $150,000. And let's say that they don't need all their money right away, and that their monthly payments currently are $650 a month or so, right? A wraparound mortgage would look something like this. The offer itself would be $150,000 at a 5% interest rate, amortized over 30 years. Now the principal and interest from this alone would be $805 a month. This amount, the $805, would be sent to the local title company. The original loan payment of $650 a month is taken from that $805 and sent to the mortgage company to keep the mortgage current. Any overage is sent over to the homeowner as their proceeds. Now, at some predetermined time, usually 3 to 5 years, the buyer will typically get a new loan and pay you off. So the question obviously comes up, well, is a wraparound mortgage legal? It's absolutely legal. Now, they're generally held as legal here in Arizona, and they have been regularly done. The popularity of doing a wraparound mortgage, however, has decreased in the last few years, mostly because of the prevalence of due-on-sale clauses in mortgages. And also a good real estate market. I mean, let's just be honest, a lot of folks, many times, are just open to selling their home outright. But when you think about it, this does not mean that they aren't done. For those properties that are problematic to sell or difficult to maintain due to distance, or for some other reason, a wraparound mortgage can actually be a good idea. So what are some of the pros and cons of a wraparound mortgage? Honestly, just like anything else, there's risk in everything. However, the main idea is to go ahead and minimize the risk when you're selling your home with a wraparound mortgage. Let's examine the cons first. Let's take a look at the bad side, right? First, and probably one of the worst things that could potentially happen, is that you could have your due-on-sale clause called. Now, most mortgages these days have a due-on-sale clause which enables the lender to call your note due and immediately payable if they feel as though you've transferred the title. Now, it's important to note that it's their right to do so, but there's no guarantee that they will. Remember, banks are in the business of getting money paid and lending money out, not holding real estate or foreclosing on it. And so long as it's being paid, and so long as the asset is producing, and so long as you ensure that your buyer is paying the mortgage on time, you're going to have a lot of protections going for you. Next, the failure of the buyer to close on the sale at the end of term. Now, in this case, your only resource for the property is the property itself. Fortunately, the laws in Arizona are very strict when it comes to people not making payments on real estate contracts or closing. You can get the house back, keep the money you've made on the deal in the meantime, and then turn around and sell it again. There's literally no limit to how many times you could sell this and make money. Remember, in this case, you're no longer acting as a homeowner, but as a lender. That's an important mindset distinction. Next, if the subject property has a VA loan, you won't be able to use your VA eligibility again until that property is sold or you remove the eligibility from that property. Something a lot of people don't know. But these loans can be done with a second loan or a wraparound. Yeah. Fourth, damage to the property. Now, literally, the only way to avoid a potential scenario like this is to sell the property completely. Okay? Otherwise, right, you just do your best to ensure that you're protected legally as well as with some proper insurance. Your buyer should name you as the insured in case of something happening, right? So now let's take a look at some of the pros. Pros, well, you can sell the property for a much higher price than you might have otherwise. One of the advantages of this form of financing is that you get to set a higher than average sales price. That's what I'm trying to say. Since the advantage for the buyer is seller financing, particularly on favorable terms, if you don't need all your money right away, you can make more money than you might have otherwise. Another benefit, you can get paid three ways. First is on any amount of money that the buyer pays you up front. Then, the amount of money that you get paid regularly on a monthly basis, as well as your final payment when the original contract is completely paid off. You get paid three ways on this. The fourth, or I should say the third, and probably one of the best potential things about a wraparound mortgage, you can avoid messy realtor fees, costly repairs, as well as time on the market. For some people, this is perhaps the biggest and perhaps the most attractive benefit of all. You can enter into a contract and close literally within days. If you have more questions about wraparound mortgages, feel free to go ahead and contact me using the form below or by calling me directly at 520-403-6227. Get a fast, fair offer on your unwanted Tucson home today. Thank you so much for paying attention, and as always, have a powerful sales day. Bye-bye.